Hello and welcome back to Investor Info, where investing is made simple. So let me pose a question to you. What are assets and liabilities? If you don't know the answer, fear not, because in today's video we're going to be diving into everything you need to know about those two terms. Let's get started. But wait a minute, I almost forgot. Before we continue, make sure that you hit that subscribe button and click on the bell icon so you'll get notified every time we upload a new video. You are not going to want to miss out. Now, let's get started for real. Your balance sheet may be divided into two categories in its most basic form: assets and liabilities. Your company's assets are the goods it possesses that can give a future economic advantage. Liabilities are the debts you owe to other people. In a nutshell, assets put money in your pocket, while liabilities take money out. But to dive a little bit deeper on the topic, let's answer this basic question. What is an asset? Well, on your financial statement, company assets are any objects of worth that you bought in a transaction. This implies that wishy-washy statements from leadership educators such as, "Your staff are your biggest asset," won't fly with accountants. Accountants enjoy numbers and must be able to trace everything back to a transaction. You may pay your employee, but that salary is expensed rather than capitalized. When a purchase transaction is expensed, it appears on the income statement. When it is capitalized, it appears on the balance sheet as an asset. Now, typically, you expense single-use or low-cost things and capitalize larger items that will be utilized over a longer period of time. Credit sales can also be used to generate assets. When you sell anything on credit, you establish an accounts receivable, which is a balance sheet asset. Furthermore, if you pay for a year's worth of rent in advance, you would record it as an asset on your balance sheet. An asset, in the broadest sense, is something of value that you own and that ideally puts money in your pocket by generating income and/or cash flow. When it comes to budgeting, income is crucial. Income is just money that you receive. As a result, an asset generates income for you. Long-term asset appreciation occurs when the value of an asset grows. For example, a modest house or stocks that you own. However, assets such as a computer or a vehicle, unless it's a unique antique model, can degrade in value, making them less desirable over time. Things like dividend-paying stocks, royalties, and patents are examples of income-generating assets. You may also discover definitions of assets that include high-end objects that you own and do not owe money for, such as your home or automobile. Now that we have a basic understanding of what an asset is, let's talk about the different types of assets. There are four primary categories: 1. Short-term, 2. Long-term, 3. Contra, and 4. Intangible. In less than a year, short-term investments will be transformed into cash. Cash, inventory, accounts receivable, and prepaid expenses are examples of short-term assets. The cash asset is the amount of money in your bank accounts after deducting any outstanding checks. Inventory refers to the products you want to sell. Raw materials, work in progress, and finished commodities are common components of inventory. Accounts receivable is the amount owed to you by your customers as a result of credit sales. When you prepay for expenditures ahead of time, an asset is created to ensure that the expenses appear on the income statement at the appropriate time. Long-term assets may be converted to cash in less than a year, but the goal is for them to stay with the firm for a long period of time. The majority of long-term investments decline. The cost of the asset is not shown on the income statement when it is bought. Instead, a yearly depreciation charge is applied to the asset to match the timing of the income statement's costs. If you're going to utilize a building for 20 years, you don't want to pay for it all at once. Property, plants and buildings, equipment, and notes receivable are examples of long-term assets. The ground on which structures are constructed is referred to as property. Land, unlike other long-term assets, do not depreciate. Buildings are typically depreciated over a 30-year period. Computers, automobiles, and even large production machinery are examples of equipment. The timing of depreciation is determined by the useful life of the individual objects. The two most important counter assets are cumulative depreciation and allowance for doubtful accounts. contra accounts are assets, but they diminish the net amount of the principal asset to which they are linked. Accumulated depreciation is the entire amount of depreciation levied against the asset. Allowance for dubious accounts refers to accounts receivables that you've written off because you don't think they'll ever be paid. Now, remember how I stated that accountants can't deal with ambiguous asset definitions? That is mostly correct. If you simply looked at accounting, any business would be worth the sum of its assets minus all liabilities. That, however, is not how the world works. Many organizations have such strong brand power or even such strong staff talent and culture that the whole worth of the company exceeds the value of its assets. When one firm buys another for more than the cost of net assets, the difference is recorded on the acquiring company's balance sheet as goodwill, an intangible asset. Other assets, such as patents, are capitalized on the balance sheet since the cost of filing the patent is capitalized. Patents are amortized over the number of years they will be valid. Now, let's move to the second portion of this video. What is a liability? Liabilities are claims made against assets. They are sometimes a direct claim, such as a bank loan used to purchase a building. Other times, a corporation will record a liability after incurring the expenditure. Just like assets, there are also different types of liabilities. However, there are only two types for liabilities: short-term and long-term. Accounts payable and accrued costs are the two most important short-term obligations. Accounts payable are charges made when you buy a product or service on credit. Normal terms will allow you to pay within 30 days. Because some construction businesses may only pay when they are paid, accounts payables may take longer than 30 days to pay off. Other balance sheet liabilities that must be paid but do not have a direct invoice are classified as accrued liabilities. Most small firms' sole long-term liabilities will be bank term loans. This might range from a 3-year loan for a trailer to a 20-year loan for a building. Liabilities include any form of debt you are repaying, such as real estate or college loans. However, it is possible that you utilize your bank account's overdraft facility on a frequent basis, incurring unneeded expenses. Now, let's talk a little more about assets versus liabilities. According to the Houston Chronicle, assets are what a firm owns in accounting, whereas liabilities are what a corporation owns. In other terms, assets are objects that provide a financial value to a firm, such as inventory, buildings, equipment, and cash. They aid a company's ability to make goods or deliver services both today and in the future. Liabilities are a company's obligations, which might include money due or services that have yet to be done. A company's assets must outnumber its liabilities in order to have enough cash or goods that may be easily turned into currency to pay its debts. If a small firm has more obligations than assets, it will be unable to pay its debts and will be declared insolvent. Liabilities, on the other hand, aren't always negative because they can assist finance expansion. For example, a small firm may take out a line of credit to acquire new tools. These tools will assist the firm in its operations and growth, which is a positive thing. The challenge is to ensure that liabilities do not outspace assets in terms of growth. The next thing we're going to be discussing is inventory versus payables. Accounts payables are frequently related to inventory in many organizations, particularly retail. You purchase goods on credit and then pay them off when it sells or within 30 to 60 days. You raise both inventory and payables in the initial transaction, but after that, the two are divided, and it is up to you to determine how and when to sell the inventory and pay off the payables. Lastly, we're going to be talking about buildings versus long-term debt. Almost all structures are financed by long-term debt. This is due to the fact that it makes logical sense. It lets your company expand because you have more room and don't have to pay for the complete acquisition in cash. After the first transaction, the two are separated, and loan payments are frequently made automatically, as in the first case. If the building is sold before the loan is paid off, the revenues will be used to pay down the remaining debt. Now, let's look at some common misconceptions about the notions of assets and liabilities. Assume you borrowed money to buy an automobile. This car is now a burden for you until you pay off the obligation for your car. However, if you utilize your automobile that has been paid off and belongs to you to produce revenue by giving other people rides for money, you may make more money than you need to maintain the car, making it an asset. The same is true for real estate. You take out a mortgage to buy an apartment or a home, this mortgage is a liability. However, the real estate will become an asset after the debt is paid off. Keep in mind, however, that even after you have paid off any related debt, property and your automobile will continue to incur expenditures like taxes and maintenance. The primary goal of creating a personal financial plan is to maximize your assets while decreasing your liabilities. Creating such a strategy entails carefully analyzing both your income and your spending. What generates income and what generates costs for you? How can you start earning extra money? For example, by allocating a portion of your monthly income to investors, you may begin to produce greater income and assets. Investing your money involves putting it towards a cause in the hope that it will create more money or a profit later on. It is possible to develop the habit of frequently educating oneself on money at any point in your life. Learning about finances is an important investment in your financial future. After analyzing your income and costs, the next stage is to understand how to make sound financial decisions and produce cash flow, or incoming money, towards your income by investing. And there you have it, folks. Now that we've discussed everything you need to know about assets and liabilities, let us know in the comment section down below what your biggest asset and liability is. Remember to always do your research and make the most of your resources. If you found this video helpful, feel free to leave a like and subscribe to our channel for more videos just like this one. See you in the next video!